Hi everyone, this is Professor Gallagher. We're going to talk about retirement and other tax-deferred plans and annuities in Chapter 11. We're going to start off with some basics and talk about employer-sponsored retirement plans first. Retirement plans are encouraged and do receive tax advantages through the IRS. This is to encourage savings for retirement or education. Generally, taxation on these plans is deferred but not eliminated. The retirement plans are going to include employer-sponsored plans and individual-based plans. Now, tax deferred does not mean tax-free. Generally, untaxed contributions are going to be taxed when distributed. Previously taxed contributions are not taxed on distribution. Contributions can provide a tax deduction to the person or company that make them. So first of all, we're going to talk about the employer-sponsored plans, and those include qualified pensions and profit-sharing plans, 401ks, 403bs, KEOG plans, simplified employee pensions, also known as SEPs, and then simple plans. These plans provide benefits to employers and employees. The employer gets an immediate deduction for contributions. The employer contributions are not compensation to the employee. The earnings from the plan investments are not taxed when they are earned, and the plan assets or earnings are not taxable to the employee until they're withdrawn. Defined contribution plans reestablish the amount of the contribution. The amount of the eventual distribution is not known with certainty and will vary. So this is defining the amount of the contributions. This is like a 401k type plan. With your defined benefit plan, this is like a pension plan. These pre-establish the amount of the benefit. So the amount of the contribution is not known and will vary depending on the returns that plan is getting. Qualified pension and profit sharing plans do have non-discriminatory minimum vesting rules, and whether the employees are required to contribute to those or not. Additions to defined contribution plans cannot exceed the lower of either $55,000 or 100% of an employee's compensation. Additions to a defined benefit plan can't result in the benefits being more than the lower of $210,000 or 100% of the average compensation for the highest 3 years. For 401k plans, those plans must meet non-discrimination rules, meaning that the plan needs to be available to everyone within the company, and certain higher paid individuals can't be contributing more than lower paid individuals within the company. The employee can elect to defer up to $18,500 per year and an additional $6,000 if the employee is age 50 or over. With the KEOG plans, these are for self-employed individuals. The contribution limits on these are generally the same as qualified plans, $55,000 or 100% of their compensation. With the simplified employee pensions, the employer creates and contributes to employee IRAs. The maximum contribution is the lower of 25% of compensation, with a maximum amount of $275,000 or $55,000. Simple plans are plans in which an employer creates either an IRA or a 401k for the employer. The employee contributes up a percentage amount up to $12,500. An additional $3,000 is allowed if the employee is 50 or older. And then the employer makes a matching contribution of 3% for all employees or 2% for all eligible employees. Let's take a look at an example of a simple plan. Generous Corporation provides a simple plan for its employees. Under the plan, employees can contribute up to 6% of their salary, and Generous Corporation will match each employee's contribution up to 3% of the employee's salary. Bob is an employee of Generous Corporation and elects to contribute 6% of his $60,000 salary. What is the total contribution that is made to his simple account? Well, between his 6% contribution and the employer's match of 3%, Bob's contributing a total of 9% of his salary for the year. So the total contribution made would be $5,400.